when we look at the VIX, a lot of folks say, oh, I don't know how much you can glean from the VIX, but what it can show you is relative volatility to other points in time. This does not seem like a very volatile time in the markets whatsoever compared to what we've seen in just the last few years.
Yeah, good morning. So, look, as you said, a VIX with a 27 handle is quite high. So if you pulled that chart, back 5 years, 10 years, 20 years, the average VIX level is actually floating more around 20. Obviously, when you have a pandemic situation where, frankly, nobody knew what was going to happen, a VIX of 80 in history is obviously the peak, but it was also very short-lived. For a sustainable period to be kind of floating above these 20 VIX levels is quite high. But I will tell you what has been interesting since yesterday is typically after Jerome Powell speaks, VIX usually drops about 5 to 6%. That's at least been true since this whole year in terms of when he speaks. So the fact that, we've continued to move higher already is a little different, and it's much more similar to how stocks and volatility behaved during Jackson Hole.
No, so interesting you bring up Jackson Hole. It was kind of like the kickoff into what could have been arguably a more volatile fall season. But there are also seasonal aspects to this time of the market, right? September, October tend to be a little bit more volatile, and then we kind of set ourselves up maybe for a bit of a year-end rally, kind of post-Thanksgiving into the new year. Is that how you see things playing out this time around?
I do. I think, in some ways, investors have been a little bit mired because of the pandemic, Tom. And I think we are sort of moving out of this pandemic era into back to a normalized playbook, at least for volatility. So if you look past to the decade, September and October is when VIX picks up. And then not too surprisingly, you hit Thanksgiving and Christmas. And obviously things slow down, volume slow down, volatility slows down. But right now, what we're looking for, which is critical, is another earnings season, your last one this year. Companies potentially provide some sort of forward guidance for next year. That's extremely important. And then, of course, you have this floating tail risk right now with escalation in Russia and Ukraine. We just don't know how to price events like that. And in particular, options tend to be very poor at pricing geopolitical events.
So if options are poor at pricing that aspect of it, there's got to be places that they are better at pricing at, right? And maybe one of those things is risk-free rates going higher the way that they are. It is in seeing economic projections play out the way that they are. And it is in maybe some ways individual stock stories playing out the way that they do. In this kind of a volatility regime, is there a strategy that you can put into place to either protect yourself or maybe even profit from some of that volatility?
We think so. The interesting thing and the good thing about options is you can create structures to both buy and sell that essentially can help you in any regime. You just have to obviously identify what that regime is first. Look, one thing we've been saying is you have to be extremely tactical right now because on an objective level, volatility is still expensive. So you want to be holding shorter term trades ahead of events, so ahead of an earnings catalyst, for instance, or ahead of a major macro catalyst. As we approach earnings, I think if you're going to start hedging some of these names, you're already seeing that pickup in demand for put options in those single names. And likely, I think that continues into earnings season. On the macro level, if you're going to carry, again, those hedges, I think you construct things through spreads. So owning an at-the-money put spread, but also selling an out-of-the-money put spread. And that helps cheapen some of your costs as you look to specific events that you can help play out.
Now, just to kind of put it in layman's terms, what you're saying is that with elevated volatility, buying some of that insurance protection for the up and downside is expensive, but you can cheapen it by selling an expensive option along with it as part of a structure. Where are you seeing more of that activity play out? Where are the profitable trades that you're seeing play out right now?
So it's going to surprise you because of how uncertain the environment is. But a lot of what we're seeing right now, even as the VIX picks up, is more volatility sellers stepping in. And it's not too surprising because if you think about how the year has played out, sure, we've had a drawdown, right, as we headed into March, but it was very orderly in the sense that the market slowly trended downwards and then slowly trended upwards. And essentially what that has allowed investors to do is to sell volatility, collect some yield, and perhaps use it to fund other elements in the market that they're more concerned about. So one aspect we've talked about is in energy, there's been kind of market outperformance relative to other sectors. And if you're going to sell calls there, collect yield, you can use that premium, perhaps fund other aspects of the market where you might expect a down move. Should there be an escalation in Russia, Ukraine, should the rates volatility increase?